Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate professionals in tax. I'm Dave McGuire. In today's episode, we'll dive into the first 100 days of the new administration. Joining us today on Let's Talk Tax is Jerry Hammel. Welcome, Jerry.
Hi, Dave. Thanks for having me here today.
So, Jerry, obviously we're in a new administration. Obviously, there's a lot of different policy proposals that were promised and everything else, very different from where we were under the Biden administration. Have we seen much of anything happen yet as it relates to corporate tax law or tax reform in this first 100 days of the new administration?
Not really, Dave. I mean, I think there's been a lot of conversation, a lot of press conferences, a lot of interviews, a lot of discussion, a lot of what I would say is you're getting a lot of positioning right now. People are trying to get certain provisions they want in the tax bill, and everybody's really positioning right now for that. But really, nothing definitive yet. I think people are posturing, okay? Mm-hmm. I think the real difficulty they're going to have is funding the tax bill under a balanced budget act.
So speaking of funding, that brings to mind, I know the House passed a budget resolution. Now, obviously, it just went through, as of recording of this, it's gone through the House, not gone through the Senate.
Yeah.
If I remember correctly, that had a limit of about, $4.5 trillion for tax cuts. So at least it gives us a blueprint. The question is that going to be enough to fund the proposals that they actually want to put down?
Correct. And right now, just as I've seen some preliminary information on a lot of the wants in a tax bill, we don't have nearly the offsets to get all of the wants in the bill. And so I think that's going to be the challenge is where are the pay-fors in any tax bill that becomes law?
Now, with that, I know the wants, I mean, it sounds pretty much like TCJA number 2. You got R&D expensing coming back, bonus depreciation coming back, lower corporate tax rates potentially even further, bring back tax rates for individuals from TCJA, et cetera. Mm-hmm. Now, I know in some of the proposals that have been out there for the pay-fors potentially, there are some things like pulling back maybe on some of the IRA provisions, but at least in everything I've read, that's very vague. There's not a lot of detail.
It's very vague, and it doesn't project out to be a lot of dollars. Mm-hmm. Okay, so there's going to have to be way more significant changes than that. A couple you left out, I think, are they also talked about. I haven't heard much talk about the child tax credit, which was a big conversation piece last year on the Democratic side. Mm-hmm.
Yeah, I know it was talked a little bit. Vance brought up the child tax credit once or twice on the campaign trail, but it never really made it into any policy proposals. The bigger thing is, as we mentioned, that blueprint that they put out there. Mm-hmm. That $4.5 trillion is at the top end of what potentially can be paid for. Because if I remember correctly, it's written as $2 trillion worth of cuts, and then dollar for dollar reduce the amount of the tax bill if they don't see those cuts. So there's a chance we don't even get to that $4.5 trillion mark.
Right, because you're saying the net's really $2.5 million. Mm-hmm. Yeah,
trillion. Yeah, we don't want to confuse. We don't want to confuse trillion and million. We're talking in much bigger numbers there. If it was only $2.5 million, we could probably handle it.
We probably wouldn't have a Let's Talk Tax episode on this if it was $2.5 million.
Yeah, that's probably a different amount.
Another interesting thing that I just read this morning actually is a proposal on the SALT cap. Mm-hmm. For the state and local tax deduction. Got pushed through really for individuals. Really, the C corporations didn't have any limitation whatsoever. And I just read this morning, what's kind of interesting is that there's some proposals or discussions of putting the similar limitation on state and local tax deductions for C corporations, so that pass-throughs, flow-throughs, and C corporations would be at the same level.
It'll be interesting to see where it all plays out because we've seen that. We've also seen the campaign promises, which was the campaign promises said, hey, we're going to get rid of this cap on the SALT deduction, which was implemented as a pay-for in TCJA number 1.
Correct.
So it'll be interesting to see how these all play out. Now, specifically to what we deal with, so mostly R&D, cost seg, those specialty areas. I know the 174 amortization has been a headache for a lot of people. Now, do we see that going away in any potential tax bill? And if so, what do we think that looks like?
Well, first of all, again, as you mentioned, that the salt cap was a funding back for TCJA. And by the way, they're calling this TCJA 2.0, right? But I think, also the 174 amortization was also a pay for. And what's interesting is a lot of the provisions in TCJA sunset. Most of them in 25, some go into 26. But that amortization requirement is a permanent change. And they did that so they could balance that out over the 10-year period when they passed TCJA. So the interesting thing is going to be if nothing's done with 174 amortization, it is required to be amortized. So they have to take action to change that. What I've heard and what I've read is I think they will address the amortization requirement under 174. However, the only retroactive piece I've heard talked about is going back to January of 2025. I've not heard a lot of cases being made to go retroactive before that. Yeah, there's some articles out there that talks about taking it back to 2022 or 2023. But as we talked just a couple minutes ago, the pay-fors with this $4.5 trillion cost, I just don't know how they could go back. That just increases the amount of pay-fors they have to come up with.
Well, and I know there have been some symbolic bills too. There was one just passed, or introduced, I shouldn't say passed. There was one introduced just a day or two ago that included a retroactive fixing on the 174 amortization. But those are symbolic in nature. They're not designed to be actual legislation. It's so people can say, look, we're fighting for you without doing anything.
Sure. It's posturing and it's a wish list. I mean, until you really get down into negotiations and you really start identifying what the cost is on one side of the ledger, and then you come up with the pay-fors on the other, it is just posturing.
My concern on that 174 is, as you mentioned, it was a pay-for in the TCJA number 1 or 1.0. The issue is we took something that was a permanent part of the tax code and we made it temporary because they're going to still be fighting under the same restrictions with the Byrd rule where it can't have a negative effect on the deficit after 10 years. It's going to be really hard for them to change this now temporary provision back to permanent. So in my mind, it's probably a good chance that, once again, it's going to look temporary whenever they fix it, most likely prospective only.
I think they're boxed in, Dave, to make it a temporary fix, candidly. And so if this is a 4-year bill, 5-year bill, in terms of sunsetting, we're going to be having the same conversation 4 or 5 years from now. And I think you're right. That was one of the major pay-fors of TCJA. And now if they take that away, I think that gets into the question of what are the pay-fors going to be in this tax bill?
Yeah. Well, and to kind of explain that for people that don't know that are listening, I think it's important to understand where the Byrd rule and everything else. So that when we're talking about that $4.5 trillion, we're talking about the cost of it over a 10-year period.
Correct.
Once it gets beyond that 10-year, it can't cost a single dollar, or it can't go through the reconciliation process that allows them to get around the filibuster. Now, that brings up other provisions that we deal with, like bonus depreciation. Have we heard anything about bonus depreciation? What's your thoughts on that coming back?
Bonus depreciation, I think the most recent thing I heard is they were going back to a date, January 2025. And I think it was maybe the 21st. It was some specific date. And honestly, I don't know I don't know the rationale behind that date necessarily. I don't know if you do.
I can guess. I believe it's actually the 20th, which, if I'm not mistaken, was Inauguration Day.
Yeah.
So they want to bring it back to the date of inauguration, and then they'll make it go forward from there.
So once again, making timing and understanding the rules really easy for CPAs.
Yeah, they don't want to go right at the end of the year. Well, I mean, that's similar to what they did with TCJA 1, is they made it based on the date that the bill came out. Now, the expectation, I'm assuming you would agree on this, is that, once again, we're looking at a temporary provision. This is not a permanent change to bonus depreciation.
I think when you go through the Byrd rule and you have this 10-year balancing, I don't really see anything that's going to be permanent in nature. I think it's too restrictive. And again, as you said, it can't go beyond the 10 years and spend one additional dollar.
Mm-hmm. Yeah, well, that's going to make it difficult, once again, for CPAs and professionals to plan, but that's why we're here. Hopefully we can help people through some of the intricacies around it. Now, we mentioned pay-fors. So obviously all these things that there's a lot of wants. Obviously, we want lower tax rates, according to people on the polls. You want to bring back 174. You want to bring back bonus depreciation. Now, I know that there's a lot of priorities that the previous administration had related to alternative energy, the IRA. Have we heard anything about that, or have you seen anything that says, hey, we disagree with some of those?
I would say nothing definitive, but I think based on some conversations and some statements, I think you're going to see a reduction in those benefits and a pulling back in that area. Where and how far each of them pull back, who knows?
Well, that's the difficulty is I think some of those areas have been around for a long time, whether it be 48, the credit for solar panels and geothermal systems. That's been around as long as I can remember. I remember working with somebody on a geothermal system back in 2002.
Yeah.
The issue is going to be how do you pull that back without pulling away things that have been. So I don't know if they're going to go after the grant programs, if they're going to go after the direct pay, but there is definitely some written ideas that they want to go after it. They're just not very specific at this point. Until we see that actual legislation, we don't know what that looks like.
Well, I think that's all true, Dave. And I think, the thing is a lot of those industries, those energy industries, the solar panels, the geothermal, that's been kind of a priced in, right, to what they charge people to do those projects and everything. So to the extent they pull those back, it's going to be pretty disruptive in the market.
Now, speaking of disruptions, there's two other disruptions that we probably want to talk about. There's the changes, obviously, and I don't know if I should call it disruption, but there have been changes with the IRS after the IRA. And there's also disruptions that are created from tariffs and changes. So I'm going to kind of separate those. So maybe we finish the conversation on what might be in a tax bill with, do we see that I think it was $80 billion worth of funding that was put in for the IRS under the IRA. I'm assuming we expect that to be pulled back.
Yeah, I think that's most of the expectations are that that'll be pulled back. You're already seeing cuts that have happened within the Internal Revenue Service in terms of termination of employees, and I think a lot of these cutbacks have already began above and beyond the $80 million that was intended to be funded.
Now, it'll be a question. What I'm interested to see is when they actually score the bill, if they include a pullback on the IRS funding or a recapture of those funds, if they see that as a pay for or a cost. Because under the IRA, it was actually seen as, okay, we're going to fund the IRS with $80 billion. They use that as actually a supplement to help pay for the bill. If they pull it back, do they say, okay, now taking that money away is a savings or is it a cost? Who knows?
we all know that they didn't take the same accounting classes we did, or I did, for example. I mean, debits and credits are a little funnier, I think, when you get into congressional projections. So,
yeah, it'll be interesting to see. Now
it will be. One other one too that was really on the campaign trail that was talked about a lot that doesn't impact our business, but that's the taxation of tips. That's another one that I think Trump's really going to push to have in the bill, and we'll just see. Again, that's another cost that we have to find pay-fors for.
Yeah, and it's going to be interesting to see how much that costs. I think the only proposal I've seen on that so far is that you allow tips to be deductible, which, of course, obviously for most lower income people that are relying on tips, they're already using the standard deduction. So you need to get above the standard deduction on tips before it makes anything. So the question will be is how they put that in, what loopholes that creates, both with the tips and also potentially no tax on overtime. Does that create opportunities for tax planning for the CPA firms or for misuse or something else that we're not expecting? And that's obviously the devil's in the details whenever these bills come out, where those opportunities create.
Sure. And I think obviously there'll be planning opportunities, but you really can't do anything definitive until you know what's going to be in the bill.
Now, taking a step back from the bill, so we sit here and talk about tax. Well, a big portion of what people are hearing about tax right now is tariffs. Now, I know tariffs don't have to go through that big tax bill. The president's allowed to institute tariffs unilaterally without going through Congress. So you mentioned disruptions. are you seeing with, obviously you have a lot more experience in corporate taxation, working as a tax director for a large regional CPA firm, with clients that you would have dealt with in the past? Is this in and out, up and down on tariffs? Do you see that as a disruption for them, or do you see that as an opportunity, or is it a little bit of both?
It could be both, just depending on their position. I think, for example, if I had a client that was doing most of their procurement in the United States, and most of their activity was in the United States, then I think it's kind of a benefit for them. There's really no change, right? There's nothing they need to do. On the other hand, if you've got a company that their engineering, their final production, their manufacturing is performed in the U.S., but they have suppliers in China, Mexico, Canada, for example, or Europe. Well, now they have to look at the cost of these goods and these tariffs that are added onto that cost. And okay, can we pass that pricing on to consumers or to wholesalers? And can we do that, or how do we handle that, or do we need to start looking at alternatives on maybe where we're sourcing our supply? And the bad thing is these tariffs, as you mentioned, can be turned on with a flip of a switch. But that kind of supply chain and the alternatives and looking for other sources, that could take anywhere from 6 to 18 months. And so this is so in the meantime, I think you're going to have some price increases that are passed on.
So right now we're sitting here and we're getting towards the tail end of 2024 tax filing season. Now the question is, with that kind of ebbs and flows, should it be something where people are trying to minimize 2024 taxes as much as possible to create some type of cash flow so they can handle some of those ebbs and flows? And are there opportunities for tax planning, maybe even on a retroactive basis, where we look and say, look, how can we get as much capital in our pocket to kind of wait out some of these changes that might be a little bit disruptive?
Yeah, I think that's not a bad strategy, Dave, because you don't know what's going to happen. How many times in February and March have the tariffs been on, then they're off, then they're excluded for this level of goods or these type of goods, or energy, for example, with Canada, it's subject at a lower rate. I think it's always good to have a little cash back for some of those unanticipated changes. But more importantly, I think there's really not tax planning necessarily with the tariffs. It's really more economic and business planning. How do I manage the cost of my product or my service so that I can still remain competitive and maintain the net income levels I need to keep my company going and keeping it going strong. I think that's where most of the planning comes into play. It's just on the business and economics. I will say, when I say there's no tax planning, I think there are pieces of tax planning. For example, if you have related party affiliated groups, and you've got you manufacture part of your supply chain or something in Canada, and you own that subsidiary. Well, there's typically required transfer pricing studies that are done. Well, transfer pricing studies will not give you an exact dollar amount of what that economic value is when you transfer that good from a foreign country to the U.S. So it's typically a range. So I think to go back and evaluate, okay, what is the subsidiary company charging the parent to finish that product, in the U.S., and could you perhaps lower the amount they're charging, right, and proactively manage the cost of those tariffs? I think there is some planning and some evaluation you can do there from the tax side there. But other than that, I think the tax planning part is pretty limited.
Well, and I would guess even with that, we need to wait till they get a little bit more stable, because you don't want to, Canada, for example, you don't want to be adjusting your cost of your goods coming in from Canada every few weeks. You want to wait till it stabilizes a little bit and see where things go.
Yep.
Now, so obviously there's some planning around the tariffs and other things that go into it. Now, pivoting back just for a minute, we've talked about future changes, but there's also been some immediate changes that we've seen, including some reductions in federal workforce and layoffs, including at the IRS.
Yeah.
Have we seen that change the way audits have been handled, like ongoing audits and other things?
Well, it's kind of interesting, because you're right. There have been terminations. They're not waiting for this $80 million to be pulled back in terms of the funding, but they've actively terminated some of the workforce, and so there's a lot of transition going on in the Internal Revenue Service right now. I've actually heard from several practitioners who had examinations that were in process, and it's been kind of interesting. They've really been charged with closing these out. You would think maybe they'd hand them off, right? Mm-hmm. But it seems like the general consensus when I talk to practitioners is that they're really starting to dig into, okay, if there's one or two issues that could be resolved quickly, fine. But otherwise, I've heard that a lot of these examinations are just being closed. And so good for their client, right? But again, you go back to some of those cuts, and does that help with revenue? Mm-hmm. Well, not if they're closing exams quickly and not really vetting issues. So it'll be an interesting process, I think. And you don't get down to those details of thought typically of like, okay, well, they let's say, 1,000 employees go. Well, all 1,000 employees had some role, and some that were in corporate exam or were taxpayer facing. There's ramifications. If they each had 3 or 4 examinations going on, those are a lot of exams they're going to close and not result in a revenue adjustment for the IRS.
Well, and even the ones that they don't close and they hand off to somebody else, well, that person might have to close 1 or 2 just to make room to handle those. So there's going to be a ripple effect.
Yeah.
Well, it sounds like there's going to be a lot of changes. I don't think we're just looking at changes over the next few weeks. We might be looking at changes over the next 6 months, next couple of years, as this kind of all floats through and we see where this goes. Mm-hmm. Now, one last question before we end up. Do you have any thoughts as to when we might start seeing some of these tax legislation, when we might start seeing bills, or is it still too soon to know?
It's a little too soon to know. I think the political climate can change quickly. But what I would say is that everything I've heard, everyone's really speculating that it's probably going to be August, September before we see law. Mm-hmm. Now, there'll be starts and stops, and then there'll be some, there'll be newsworthy press conferences and things. But I really think it's going to take that time to really get through the details of the tax bill, write it, and then more importantly, find the pay-fors and organize that. I think that's going to delay it. I would, ideally, I'd love to see something in June, but I think it's probably going to tick later in the summer.
Yeah, I would agree with you. I do know they're not going to want to wait till the end of the year, because they definitely don't want those paychecks to start changing when the individual rates fall off on January 1st.
Right.
So we're pretty sure it's going to happen sometime in 25. It's just a question of when.
Yeah, and one thing I can tell you is that, I know businesses get frustrated because how do you plan for something, and it's great, it's retroactive, but I don't have the ability to go back and buy a piece of equipment or make an investment in a building. So I think that's what's frustrating. But I can tell you that politics really don't care about practical business planning, unfortunately. So I think the best thing you can tell your clients is still continue to make good economic decisions, good business decisions, and maybe run a couple scenarios so that you understand the tax impact under sunsetting, where you lose those deductions or you're required to amortize 174. And the other scenario is, okay, the bill gets passed and it's retroactive to the beginning of 2025. And then just know that, okay, my tax bill might be just a little higher this year, and if it's not, well, I've got a little windfall of cash that I can redeploy into my business.
Yeah, it's always don't let the tax tail wag the business dog.
Exactly.
Make sure the business is on sound footing. I always tell people, I can always figure out a way to get anybody not to have to pay tax, but it requires your business not making money, so that's not necessarily the best scenario. So
yeah, nobody really wants to do that. Yeah.
Well, thank you for your time today, Jerry. It was great talking to you and learning more about where you're seeing these tax laws go and having a nice conversation.
Yeah, I've enjoyed it, Dave, and I'm just as curious as everybody else as to see how this plays out. And who knows, we'll have a couple more episodes on this, I'm sure.
Oh, I'm sure. Thank you for taking time to tune in today. You can subscribe to the Let's Talk Tax podcast on YouTube and follow us on Spotify or Apple Podcasts or wherever you listen. In addition, today's show notes and links to more about this episode can be found online at McGuireSponsel.com/Let's Talk Tax Podcast. We'll see you next week. Thanks, everybody.